Welcome to Capital Allocation Lab Calm, audio first lessons that turn classic investing and economics into practical judgment for long-term owners.
If you value fundamentals over hype, you're in the right place.
Before we begin, if this episode helps you think a little more clearly about risk and return, please like and subscribe.
It's the simplest way to support our work and keep these lessons coming.
And drop a comment with your questions, or tell us what fundamental investing concept you want us to tackle next.
Just a quick reminder, this is educational content only. It's not personalized investment, legal, tax, or accounting advice.
Okay, so today we are diving into part 2 of security analysis.
That's right, the section on fixed value investments, and we're really going to zoom in on Chapter 6.
Which is basically the playbook, right?
It's the playbook for how to select bonds and other fixed value securities in a way that's disciplined, realistic, and, frankly, built to survive.
You know, the phrase fixed value itself sounds almost quaint now, doesn't it?
It really does. It feels like something from a different era, like a promise the world no longer makes.
But that's exactly why this chapter is still so relevant.
Exactly. This isn't some nostalgia trip. It's a blueprint for how to think when the label on a security is, trying to seduce you into forgetting what's really going on with the underlying business.
That's the core tension, isn't it? The label versus the actual reality.
Mm-hmm. And the central theme for our whole discussion today is really simple.
What's that?
If the cash flows aren't there, the paperwork won't save you.
If the cash flows aren't there, the paperwork won't save you. I like that. It's the bumper sticker for this whole deep dive.
It is. So let's maybe start with a bit of a mental reset.
Okay.
When most people hear the word bond, what do they picture in their head?
Safety. A steady coupon, getting your money back on a specific date. Priority.
Right. And those are all real things. They're structural characteristics.
But they aren't safety itself.
No. A bond is a promise, but, a promise is not a payment.
Payment comes from the ability to pay.
And Chapter 6 is surprisingly modern about this. It's not obsessed with the labels, first mortgage, secured, senior, all that.
It's obsessed with the issuer as a business, an operating enterprise.
So a bond is really a claim on a business.
And here's the kicker. It's not even primarily a claim on property.
That is the line that shocks people, because the traditional view, the one you get in like a Finance 101 class, is
I've got a lien on the factory. If they don't pay me, I take the factory, I'm fine.
And Chapter 6 basically just says, hold on a second. A lien can matter, sure, but it is not the foundation. The foundation is whether the business can actually meet its obligations.
And the reason is just brutally practical, isn't it?
Completely. Collateral values just don't behave the way you imagine they will when a business is breaking.
The melting ice cube problem.
Exactly. When a business fails, why is it failing? Usually because those assets aren't generating cash anymore. So the factory, the specialized machinery, it all just shrinks in real-world value.
And even if it has some value, getting it is a whole other story.
It's slow, it's messy. The path from I have a lien to I have my money back is, well, it's a long road through courts and reorganization plans.
Which brings us to a really key guiding principle for the whole chapter.
The goal is not to be protected in trouble.
The goal is to avoid trouble in the first place.
Right. I mean, fixed value investing is meant to be conservative. If you're banking on the reorganization process, you're not really doing fixed value investing.
You're doing distressed credit work.
Which is a totally different sport. And a much, much more dangerous one for most people.
Okay, so before we jump right into Chapter 6, the book's introduction to this whole section gives what you could call a translation layer for today.
Which is so helpful because the language of finance has really shifted.
Take just the word investment.
Right. It used to mean something very specific, something like conservative, prudent, safe.
Whereas today, anything you buy for a financial gain gets called an investment.
Yeah.
A lottery ticket, some super volatile crypto coin.
All investments. But the old authors were really careful to separate investment from speculation.
So for our conversation, when we say investing, we're talking about decisions based on analysis, conservatism, a margin for error.
Not vibes, not predictions.
Not, I heard this bond is going to pop.
Definitely not that. There's an old quip that really captures the danger here.
Which one's that?
Something like, a speculator knows the risks they're taking, but an investor is often unaware of the risks they're taking.
Ouch. That's uncomfortable because it's true.
It's uncomfortable because it points to the sedative effect of labels. You hear bond, senior, investment grade, and your brain just kind of relaxes.
You think the label did the work for you.
And relaxation is the absolute enemy of good credit work. Credit demands vigilance, it demands humility, it demands being able to say, I'm not sure, so I'm passing on this one.
Which is the exact attitude Chapter 6 tries to build.
The introduction also traces how the standards for managing money have evolved.
And this isn't just a history lesson. It explains a lot about how markets behave today.
It started out very rules-based. Certain things were just forbidden for fiduciaries.
And if you had one loss on a single security, you could be punished, even if the whole portfolio did great.
So it encouraged one thing above all else: avoidance. Stay away from anything that looked risky by category.
And it shifted to the prudent person idea.
Right, where you're judged in context. Across the whole portfolio, a single loss wasn't a career killer if the process was sound.
And then came portfolio thinking, diversification.
The idea that a risky asset could actually lower your total risk if it was uncorrelated with everything else.
And finally, the big shift.
Yeah.
Thinking in terms of risk and return.
Moving from risk avoidance to risk management, which in theory is progress. It's more sophisticated.
But it creates a new trap.
A new temptation. If anything can be justified on a risk-adjusted basis, then nothing is off limits. People start buying junk just for the yield.
And that's where common sense has to kick in.
Common sense, like. The downside matters way more than the upside in credit.
Let's really hammer that point. With a normal bond, your upside is capped. You get your coupons, you get your principal back, that's it.
But the downside? Well, a default can wipe out a huge chunk of your principal.
That asymmetry is everything.
And it's why bond selection is, as the book calls it, a negative art.
You win by not losing.
You win by screening out the companies that can't pay. It's almost the opposite of picking stocks, where you're hunting for the big winners.
Here you're hunting for potential disasters and just taking them off the list.
And that's why this is a capital allocation topic. Buying a bond is a judgment on a company's own capital allocation choices.
So there's another modern idea in the intro that really clicks with Chapter 6.
Which is?
That no asset is so good that it can't be a bad investment at too high a price.
And conversely, almost any asset can be a good one at a low enough price.
This is so important for fixed income because people treat safety like it's an absolute thing.
Like it's a permanent property of the bond itself. Is this bond safe?
But safety isn't a property. It's a relationship.
A relationship between price, the legal structure, and the company's ability to pay.
So the question isn't just, is this safe? It's, is this safe at this price?
And the crucial one, safe under what conditions?
And that's where Chapter 6 gets ruthless. It forces you to think about depression conditions, not just the good times.
Right. Don't underwrite the bond based on the best year the company ever had.
Underwrite it based on a plausible hard year.
Exactly. The intro also takes a bit of a shot at these tidy quantitative models that people love today.
The ones that make risk look like a mortality table.
Yeah, and the critique is timeless. Investment losses are not evenly distributed.
They cluster.
They come in storms. So a model that's calibrated on calm weather looks brilliant, right up until the hurricane hits. And that's when it fails you.
Which is why Chapter 6 is all about avoiding the borderline cases to begin with.
Not because you're anti-return, but because the penalty for being wrong in credit is just so lopsided. One default can wipe out years and years of coupons.
So the introduction gives us this really useful bridge. It lists 7 ideas from a professional credit mindset that connect the old theory to modern practice.
And it's a great field guide for individuals.
Okay, so number 1 is the asymmetry we just talked about.
Limited gains, potentially huge losses, so the job is to avoid the losers.
Number 2, start with minimum standards.
You work up from what must be true, not down from this story seems fine.
Third idea, credit risk is basically about leverage and instability.
High leverage plus unstable cash flows. That's the machine that breaks under pressure.
But stable cash flows can handle leverage, and low leverage can handle instability.
You just can't have both high leverage and high instability. That's the kill zone.
Number 4, analysis has to be multifaceted.
It's not one ratio. You have to look at the industry, management, coverage, liquidity, the covenants, everything.
Fifth idea, there are no permanent investments.
That's worth repeating.
There are no permanent investments. Facts change, so you have to keep checking.
Sixth, don't be a macro hero. Don't try to time bonds based on what you think the Fed's going to do.
Focus on the knowable, the business, the balance sheet.
And seventh, diversification is essential. It's just humility. It's acting like an insurance company because you know surprises will happen.
Okay, with that bridge in place, I think we're ready for Chapter 6 itself.
Let's do it. It starts by defining its scope. High-grade straight bonds and high-grade preferreds.
But it also includes some edge cases, which I find interesting, like common stocks that actually behave like senior claims because of some guarantee.
It's a great reminder that the book classifies things by their character, not just their labels.
Which is a very capital allocation way to think.
Definitely. But then it immediately gives a warning about preferred stocks.
That most of them do not qualify.
Right. Most of them are not protected well enough. Their dividends aren't a contractual promise like a bond coupon. So they belong in a more speculative bucket.
So the takeaway for today is, don't just look at a preferred stock's yield and assume it's safe income.
Exactly. Then the chapter asks this really modern-sounding question. Is bond investment even logical?
I mean, does it make sense to give up all that upside for safety that isn't even guaranteed?
And the authors who are writing after some huge market collapses basically say yes, but
But you have to raise your standards.
you have to be more exacting.
Yeah.
And you have to remember what a bond is. A commitment with limited return.
And once you accept that limited return,
The whole game shifts to avoiding loss.
and there it is. Bond selection is primarily a negative art.
A process of exclusion and rejection, not search and acceptance. You don't have to swing at every pitch. In fact, you can let a lot of good ones go by.
But accepting one bad one can be a disaster.
And then they quote this great banker's rule. If there is a difficulty or a doubt, the security should be declined.
That is the polar opposite of reaching for yield.
Completely. When you're reaching for yield, the difficulty and the doubt are part of the sales pitch. Yeah, it's risky, but look at that coupon. Chapter 6 says no.
Okay, so then they lay out the 4 core principles.
Let's walk through them. Principle 1. Safety is measured by the ability to meet obligations, not by the legal lien.
Principle 2. You have to measure that ability under really tough conditions, like a depression, not just in the good years.
Principle 3. A high coupon cannot make up for deficient safety.
And Principle 4. Selection requires rules of exclusion. You need quantitative tests, minimum standards.
If you just take those 4 ideas, you're already way ahead of the game.
So let's dig into that first one because it's the big one. Ability to pay versus a lien.
This is the break from the old view. The old view was, a bond is a claim against property. The newer view is, it's a claim against a business.
And the old view fails in practice for a few reasons.
3 main reasons. First, as we said, property values shrink when the business fails. Especially specialized property like a railroad line or a factory. Its value is tied to the business's cash flow.
So citing the original cost or some appraisal value is just misleading.
Totally. Second reason, enforcing your lien is hard. The legal system doesn't just let you foreclose and walk away. It usually ends in a messy reorganization.
And third, delays.
Even if you eventually get paid, the process can take years, and in that time, markets drop, you lose opportunities. It's just a mess.
So protected trouble is still trouble.
Exactly. Now, once you accept that, a bunch of practical ideas or corollaries fall out of it.
The first one is almost heresy.
It is. The absence of a lien is not automatically a deal breaker.
An unsecured bond from a strong company can be much safer than a secured bond from a weak one.
Let's say that again because it's so important. An unsecured bond of a strong enterprise can be sounder than a secured bond of a weak enterprise.
Because the business's capacity is what matters, not the paperwork.
And that leads to the second corollary, which is the one that always starts a debate.
The theory of buying the highest yielding bond of a sound company.
The logic is pretty clean. If a company is truly sound, then all of its applications should be sound.
So conversely, if its junior bonds are not safe, then its senior bonds aren't really desirable either.
Because it means the company itself is weak. So theoretically, what you should do is find a great company that passes all your tests.
And then buy its highest yielding bond, which is usually the junior one.
That's the theory.
And then reality kicks in.
Because we all make mistakes. And buying the senior bond is kind of like paying for insurance against your own judgment error.
But here's the psychological trap.
If you feel you need that insurance because you're shaky on the business, you probably shouldn't be buying any of its bonds.
That's the yield trap right there.
The chapter gives this great example of 2 bonds from the same company in a crisis. The senior bond was trading near par, low yield. The junior bond was trading way down with a huge yield.
The person buying the senior bond is paying a massive premium in loss yield every year.
For what the authors call only partial insurance. And their conclusion is sharp. Either don't buy the company's bonds at all, or, if you're really confident, buy the higher yielding one.
Because paying that much for a thin layer of priority just doesn't add up.
And they add that in a real collapse, even the senior secured bonds can see their prices plummet. Priority does not prevent volatility.
But they don't always prefer the junior bonds, do they?
No, they give a very practical rule. Favor the senior Lien unless the junior one offers a substantial advantage in yield.
So if the difference is tiny, just take the senior bond. Pay the small insurance premium.
It's a balanced human rule. It recognizes uncertainty.
You just have to be proportional. If you're going to move down the capital structure, get paid for it.
Meaningfully, not for crumbs.
The chapter then walks through this whole comparison of a junior bond from company X versus a senior bond from company Y.
And the rule is basically, choose the junior bond of company X only if X's total debt protection is adequate. And D, the yield is a lot higher.
Or if the yield is much higher, then the protection at company X better be a whole lot better.
It forces you to look at the whole picture, not just the first mortgage label.
Then there's this special topic of underlying bonds.
Right. These small issues on really key assets, like a vital piece of railroad track, they were thought to be almost bulletproof.
But the book points out that even these invulnerable bonds got hit hard on price when the overall system got into trouble.
And the conclusion is, again, very humble. It's really hard to know in advance which ones will sail through and which ones won't.
So the ordinary investor is probably best off just sticking to the main rule.
Only strong companies have strong bonds. Don't get too clever with structure.
Because clever structure is just seasoning. The business strength is the meal itself.
That's a great way to put it.
So how do we make this practical today? Let's try to build a sort of Chapter 6 checklist.
Okay, let's do 3 layers. The business, the balance sheet, and the terms of the bond itself.
Layer 1, the business. Is it stable? Do you understand it? Are its assets adaptable, or are they super specialized?
That's the lien fallacy right there. If the assets are specialized and the cash flow is shaky, the collateral is not a comfort blanket.
Layer 2, the balance sheet. How much total debt does it have relative to its earning power? And more importantly, what does interest coverage look like in a bad year?
Right. If operating income falls by a third, is there still a cushion? You don't need a perfect number. You just need a credible cushion.
And liquidity.
Mm-hmm.
Cash on hand, maturity schedules.
Because a lot of defaults are about liquidity. A company can be fine long-term and still fail because it can't refinance at the wrong moment.
And layer 3, the terms. Where are you in the capital structure? What do the covenants say? What stops them from just piling on more debt?
If the protections are weak, you either demand a higher return or you just walk away.
And through all of this is the final question.
Safe at what price?
Exactly.
You know, it's also important to separate credit risk from interest rate risk.
This chapter is all about credit risk. Will you get paid?
But today, you also face duration risk, your bond's price moving around because of interest rates.
The key is not to panic about price moves from rates if the credit is solid, and not to ignore price moves from credit worries just because it's called fixed income.
A bond can have a fixed coupon and still give you a very non-fixed outcome.
Okay, let's circle back to preferred stocks for a minute, because a lot of people own them for income.
The message here is really clear. Only the exceptional ones should be treated like fixed value investments. Most of them are junior, and their dividend safety is not beyond reasonable doubt.
You have to treat them like a hybrid. Equity-like risk, bond-like pricing.
And you have to ask about the call structure, too. A high yield can just get called away from you.
You know, there's a big behavioral lesson in all this, too.
It is.
That markets are social. When things are popular, spreads get tight.
People convince themselves the junior bond is basically as safe as the senior one. They forget about the capital structure.
And then trouble hits, and the market remembers all at once. Spreads blow out.
And you realize you were collecting a tiny extra yield for a huge hidden risk. Chapter 6 is trying to protect you from your own optimism.
Okay, let's do a quick math example on the depression conditions idea. Keep the numbers simple.
That was good.
Let's say a company makes $500 million in operating profit in a normal year, and it pays $100 million in interest.
Okay, so that's 5 times coverage. Looks very comfortable.
Now, stress test 1. Operating profit falls 40% down to $300 million.
Interest is still $100 million, so coverage drops to 3 times. Still okay.
But now, stress test 2, a really cyclical downturn. Operating profit falls 70%.
Down to $150 million. With the $100 million in interest, coverage is now only 1.5 times.
Now we're getting close to the edge.
And that's before other needs, like working capital. The point isn't to be perfectly predictive. The point is to see if the bond's safety relies on everything going right.
If it does, It's not a fixed value investment. It's a speculation.
And that's where the principle, a high coupon can't compensate for deficient safety, comes in.
Because modern markets will offer you that deal all day long.
They will, but the principle is saying, don't let the coupon hypnotize you. If the principal is at real risk, that extra yield you collected for a few years can vanish in an instant.
It's all about that asymmetry of loss.
Exactly, which is why the process encourages rejection when there's doubt.
Let's tie this all back to capital allocation one last time.
When you buy a bond, you're underwriting management's behavior.
You're betting on them to protect the balance sheet, to not over-lever in the good times.
You're betting on their culture and incentives. A covenant in a document is one thing, but a management team determined to gamble will often find a way.
So the ultimate protection is picking strong businesses run by people who respect the balance sheet.
Let's try to summarize the whole thing into 10 key takeaways.
Okay, I'll start. 1. Remember, the bond's nature is limited return.
2. So your top priority has to be avoiding loss.
3. Safety comes from the ability to pay, not the lien on the paperwork.
4. Test that ability under hard conditions.
5. A high coupon is risk compensation, not a free lunch.
6. Use exclusion rules. You have to have minimum standards.
7. Don't substitute a clever legal structure for actual business strength.
8. If you do go junior in the capital structure, get paid meaningfully for it.
9. Diversify.
Yeah.
It's just humility in practice.
And 10. Review your holdings. There are no permanent investments.
And if we had to boil it down to just one sentence,
Bonds are claims on businesses, so analyze the business, not the brochure.
I think that's a perfect place to leave it. The world changes, the instruments change, the language changes.
But the investor's job is the same. Protect principal. Demand a margin for error.
And treat every fixed promise not as a statement, but as a question.
What makes this promise believable? That's Chapter 6.
Thanks for joining.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And leave a comment with your questions, or tell us what fundamental investing concept you want us to tackle next.
Thanks for joining, and we'll see you in the next episode.